This is the current federal tax developments for the week of November the 24th, 2025. Current federal tax developments are brought to you by your state society of CPAs. I'm Ed Zollers, and I am broadcasting this week from a bit of a cloudy Phoenix and looking at what's gone on this week, the week just before Thanksgiving, dealing with federal tax issues. And with the IRS back at work, we've had a lot of things come out this week. So we're going to take a look at what we have right now. We're going to talk about a case involving innocent spouse and determining when somebody qualifies for that relief. This will be a case where the spouse in question gets relief for some but not all years, because at a certain point she became aware that their tax liabilities were not being taken care of by her husband, at which point the court felt that it no longer was a case of she was truly innocent, but was more or less just going along. In essence, not paying the taxes might have been a little bit better for you financially. So, didn't really rock the boat on that issue. This week, we also had announced the premiums and the, for us, key because of the implications of the IRMA calculation, the adjustments to Medicare Part A, B, and D. So we're going to talk about those and what Social Security told us about that. We also have a pre-2019 alimony, a divorce agreement that's going to get into a question about whether a payment represented alimony. Those cases are still around. And this is a case of also a situation that developed largely because it turned out that one of the spouses refused to pay for a quadro. So the other spouse didn't chip in and get it done. And it came back to harm the spouse that basically didn't chip in because, his ex was not going to chip in as well. We'll talk about how things worked badly for him in this case. By the way, quadros are somewhat important when we're going to talk about the question of the dividing up a employer retirement account in this case, because if you don't have one and you're still under order by the court to divide it, what's going to happen is going to be a very bad tax consequence for the employee. We're also going to talk about the IRS put out information to implement the new Section 139L interest exclusion for those in the business of lending who lend on certain farm debt. And finally, we're going to talk about a special set of relief that came out Friday that we've been waiting for. This is talking about the deduction for tips and overtime compensation under the One Big Beautiful Bill Act and the relief for 2025 returns that is being provided to those receiving such payments. We had already had relief granted to those making such payments where they didn't have to provide the information returns this year that are required by the law. But because those returns are key for the employee getting a deduction, we now have another set of relief about how employees are going to handle it this year. So with that, let's go first to that innocent spouse case. This is a case of Sample versus the Commissioner. Tax Court Memorandum Decision 2025-118. This decision came down on November the 17th. Now, this is going to focus on Internal Revenue Code Section 6015. This is the provision that provides for innocent spouse relief. And we're going to be looking at the key impact that knowledge of the problem impacts when you're trying to make a claim under either 6015B, C, or F, right? Now, the taxpayer sought relief under 6015B that there was an understatement that she wasn't responsible for. Under 6015C, a deficiency that was allocated in their divorce decree, an allocation there, and also equitable relief. She just simply, there was an underpayment and it would be inequitable to hold her responsible for that payment. Now, in this case, for a standalone petition where this is the entire issue under 6015, the tax court applies a de novo standard. It reviews the administrative record plus any newly unavailable evidence that is introduced at court. In the context of a collection due process case, when this relief is raised during a CDP hearing, the review standard transformed to the same de novo standard provided by 6015E7. In this case, the taxpayer had agreed to a fully stipulated record under Rule 122 in the court. So she failed to introduce any newly discovered evidence available under the de novo review standard. So only the evidence that was actually part of the administrative record was going to be considered by the court in this case. Now, in this case, she was the office manager and receptionist for her husband's dental practice, and that was the source of the couple's income. Now, what happened over the years is her husband ceased reporting income from his practice in 2011. That definitely helped lower your tax. And in 2014, omitted nearly $200,000 of business income. Oh, and by the way, that wasn't quite enough. So they also omitted the spouse's own W-2 wages were not on the 1040. Now, they were legally married in 2019, legally separated, say, in 2019, in March, shortly after Sample learned the full scope of how bad of a position they were in financially in general, not just taxes. They were in deep trouble financially. Now, the agreement was favorable to her, granted her the marital home, a second home, and their 401k, or the 401k entirely. And the husband assumed sole responsibility for all the tax debt. And what's going to become a critical date in this case is in 2015, there was a visit by a revenue officer that served as a warning to her, a dividing line for the court in determining the reasonableness of her ignorance of the situation. That sudden appearance of an IRS revenue officer looking for money should have put her on notice about the fact that, you can't just kind of assume everything's taken care of itself. That just didn't happen randomly. And that was where we're going to find the court divides line between where they will grant her relief and where they're not going to grant relief in this case. Now, under 6015, the question of the understatement, which is under that relief, that was denied for 2014. In this case, she failed the did not know and had no reason to know there was an understatement test. As office manager, she was office manager of the practice. She had insight into their income. And the omission of her own W-2 wages, that's something you probably should notice on your return. Your W-2 wages aren't there. I don't care what you're saying about your spouse not really reporting everything. You know you got wages. You're the office manager. You knew that, right? How could you not notice that that was a major error on the return? So she said that, the court says, look, 6015B does not protect you if you are intentionally ignorant. She was not reviewing the return. And, and it's never good to tell the court you're not reviewing the return. I'm going to tell you flat out. If your spouse is threatening you, right? Threatening you with abuse, physical or mental abuse, that basically gets you to not look at the return because bad things are going to happen to you if you do. That's a different scenario. That's not being alleged here. She just didn't look at it. Well, you've got a responsibility to look at your return. Let's be honest. You got a responsibility to review it. And, the idea is if you did the minimal review of the return, you would have at least noticed your W-2 was missing. And you might have wondered how come there was no income from the practice. How was that missing? And so the court said you are maintaining willful ignorance, intentionally ignorant, and that's not going to protect you. Now, in 6015C, though, which is the allocation of the debt, this relief was partially denied for 2014. And this case was more favorable to her because the IRS had to prove she had actual knowledge of the understatement. What they said was the IRS met its burden for the unreported business income. She knew the practice was their main income source, and it wasn't on the return. That's one of those things saying, well, you knew that. You had to know that, right? There's no way you avoid knowing that. They did, however, say that for other components like capital gains, the IRS had failed to produce evidence to support the idea that she had actual knowledge of those shortfalls. As such, the court was fine there for the 2014 claim. Now, when we get to 6015F, equitable relief, a couple of problems she had there. She did fail the economic hardship test. Her total monthly income was $12,000 per month, and that exceeded 250% of the federal poverty guideline. And she could make payments toward the liability while maintaining reasonable living expenses, given her assets of about $900,000. So ultimately, though, the result hinged on the knowledge factor for the underpayments. For 2011 to 2013, they granted her relief because she reasonably relied on her husband's assurances that the tax debts were just temporary and were being taken care of. However, for 2017 and 2018's underpayments, the relief were denied. This is where the 2015 visit comes in. She was now aware these debts were not taking care of themselves, and they certainly weren't just short-term temporary issues. They were dragging back all the way to 2011, and a revenue agent shows up in 2015. You are aware now that you're not paying the debts, right? You're aware now that these debts are piling up. In that case, she had reason to know that her husband simply wasn't paying the debts. And again, just not looking, I just won't look and it's not there isn't going to help here. Once you're aware of the problem, she is no longer ignorant. She's signing a joint return, right? There is a liability with signing a joint return, and that is you're jointly and severally liable for what's on there. And kind of a problem for her in this case. So, bottom line, what this ruling really helps us understand is the difference between the actual knowledge standard of 6015C and a constructive knowledge standard that applied under 6015B. Remember, 6015B, if you had reason to know, while 6015C requires a service showing that you had actual knowledge of the amount. And so 6015F for liabilities is going to be more of a problem, equitable relief. It wasn't equitable to hold her liable while she believed they were being paid, but it was no longer reasonable for her to believe her husband was paying those things off once the revenue officer showed up. So for the years in question, because we're asking for relief in 2011, in this case, 2012, 2013, 2014, and then also for underpayments in 17 and 18, were before the court. Yeah, in that case, the revenue agent showed up in 15, the debts aren't being paid. You should keep your eye on debts being paid on future returns. She, of course, decided to let's just, bury our head in the sand and see what happens. And playing ostrich doesn't necessarily work well for you in these cases. Next up, we did get the announcements of the adjustments to Medicare's Part A, B, and D. This was announced by basically the Center for Medicare Services website, CMS, and titled on their webpage 2026 Medicare Parts A and B premiums and deductibles, published on November the 14th. Now, that posting focused on finalized premiums, deductibles, and income-related adjustments, right? The IRMA amounts for the 2026 calendar year. For Part B, the standard premium will be set at $202.90 for somebody under Part B standard monthly premiums, right? This is an increase of $17.90 from the rate this year of $185. The annual deductible for Part B will rise to $283 for 2026. That's up $26 from the 2025 deductible of $257. And these increases are attributable primarily to projections of price changes and assumed utilization increases by those covered by Medicare. And it is noted that there is a mitigation note. There is a spending changes regarding skin substitutes offset a potential $11 a month premium increase, if that applies to you. So obviously that's there. Let's talk about the IRMA scope now. Income-related adjustments, right? Affect approximately 8% of those paying Part B, and a much larger percentage for many of us of our clients who are receiving Medicare. Now, the threshold at which IRMA begins for an individual, right? somebody not a joint filer, essentially, you're going to have $109,000, up to $109,000 of IRMA, which starts with AGI and then has various adjustments on top of that. That's going to keep your premium at the standard. You'll pay the standard $202.90 premium. If you are a married couple filing a joint return, that number doubles to $218,000. And again, keeps the individual premiums at $202.90 for the standard Part B premium. Now, the first IRMA tier will add $81.20 every month to your premium. And for individuals, that's going to be for $109,000 of basically modified AGI for the IRMA test to $137,000. And for married couples filing a joint return, $218,000 to $274,000. For those individuals, the monthly premium will be $284.10. In the highest tier, and we're just going to go there, you can check the others. This is how bad it gets eventually. Once your modified AGI is below $500,000 for an individual and above $750,000 for a joint filer, and as you quickly notice, this now has a marriage penalty in it as well, your premium is going to rise by $487. Well over twice the original premium. And what that's going to do is raise the monthly premium to somebody who had modified AGI above $500,000 if single, $750,000 if married filing joint, to $689.90 per month for Part B. So again, remember to warn your clients that, if they had their modified adjusted gross income, that they showed on the 24 return, or their AGI for the 24 return, after we do the IRMA adjustments, which includes, as I recall, the add backs here will include things like the interest that goes into calculating taxable Social Security, the tax exempt interest, that their premium will be way higher per month than the 202.90. That's especially important for somebody who faces, let's say, a one-time big capital gain. They invested a lot in NVIDIA. Now they dump their NVIDIA stock. They have this big gain. Well, they're going to spend a year probably there. You can appeal and ask for IRMA to be reduced. In theory, there's a list of things you could qualify for, and most of them people aren't going to qualify for. However, multiple people have reported that it kind of depends, and there appears to be a lot of discretion that Social Security has, to waive this, the way it ends up being done. And even some cases of people who have asked one particular person, went to one office and asked for a waiver, told no, went to another office and talked to somebody and said, oh yeah, sure, we'll waive it here. So understand IRMA waivers are available. Take a look at, obviously, if you clearly fall under the list that you'll find on the website of conditions that do, let's say ultimate sale of an income producing asset. So you permanently lost that income in the future. That's the type of thing that will generally qualify you to ignore that income. But we've seen people get it for all kinds of odd things. So kind of just be aware of that. Under Part D, which is the prescription drug coverage and special Part B coverages, these have, IRMA-based adjustments follow the same MAGI tiers as Part B. The first tier starts, adds $14.50. So that's going to be on a joint return, $218,000, $109,000 other returns. And at the highest IRMA tier, it's going to add $91 to their monthly premium for the prescription drug benefit. So if they also have Part D, you got to add that to the addition that's going into Part B. Separate tables apply to married individuals filing separately who live with their spouse point during a year. And in that case, the middle income tiers consolidate into a very, very large band, right? Where you're going to get a lot of the IRMA tiers are going to be on a much larger band, largely because of the thought that if you're married separate and you lived with your spouse, you might be doing it to try to lower IRMA for one or the other. So because of that, remember, if they're living together, they want to file marital separate, but they're living together and they're getting Medicare, there's special issues you got to look for to deal with potentially making IRMA worse. So be aware of that. And for I'll get this right, immunosuppressive drug coverage, that specialized Part B coverage after a kidney transplant will pay a standard premium of $121.60, per in 2026. And IRMA does apply to that. It's a little bit specialized, so we're not going into it here. For Part A deductibles and voluntary premiums, Part A inpatient deductible for 2026 for Medicare Part A, the hospitalization insurance, which you don't pay for unless you sign up late, is $1,736. That is up $60 from the 2025 amount. Hospital co-insurance is going to be $434 daily for days 61 to 90. And you have lifetime for the reserve days, give you $868 daily. Skilled nursing co-insurance for days 21 to 100, if you otherwise qualify for this, will give you $217 daily. If you have voluntary Part A enrollment who are paying the full premiums. For an otherwise uninsured individual with fewer than 30 quarters of coverage, they will need to pay $565 per month in 2026 to get the hospital coverage. This is something, as somebody who's been very aggressive in avoiding paying Medicare tax, will suddenly discover to the dismay that they don't qualify for Part A. They don't qualify for the automatic Part A, and they have other problems with losing Medicare. It gets way more expensive. And yes, I've had a client, a client we hadn't ever done who came in and suddenly it's like, you've not had 30 quarters of Medicare of premium coverage. Of coverage under the Medicare, you haven't paid in. And it's like, no. I was told that was a great tax savings deal. It's like, okay, first thing is really it wasn't because you did your S Corp in a way that didn't really work, but you never got caught. But number two, having done that, you've now cheated yourself out of Part A coverage. In essence, you went whole hog and got rid of everything. It's like, there's a downside to that. This is the downside. Now, the rate changes basically confirm that you're in planning at reducing the modified AGI below the IRMA thresholds, including the base threshold at 109 or $218,000, but also those higher ones. Remember, IRMA is a cliff. Once you go over by $1, the limit, you're not going to pay a significant amount more per month. Each time you clear it's there, that's important for IRMA coverage. This is why I have been insisting that people understand there is a huge misunderstanding that went out regarding the impact of the deduction for tips, overtime, new car interest, and most importantly, these special, deduction for those over 65, where a lot of publications, general publications for the public, but even some that claim to be, professional tax publications, will tell you that those deductions reduce AGI. They do not do so. Follow the code. Read the code. If you read the code, you're going to discover that if you take a look in section 63, which is not where AGI is computed. AGI is computed under section 62. All of these items are deductible under 63. You still get them if you don't itemize, just like QBI. QBI is in there too. Always has been. It does not reduce AGI. You all know that, right? No question. Well, these all went in the same place. So that means that the car loan interest will not reduce AGI and therefore will not reduce your IRMA calculation. The tips, the overtime will not reduce an IRMA calculation. And remember, there are definitely a lot of people who are still working, after age 65, not receiving, they're not claimed their Social Security yet. They may still qualify for those. Don't think that doesn't matter because this is for those who are retired. No, you pay Medicare just like I pay Medicare now because I'm 65. And, I'm still working, clearly, right? I'm still working, still doing all this stuff. I have to worry about IRMA. And you need to be aware of that. And obviously, the 6,000 is a big problem. Be very careful and watch for IRMA when doing your calculations if the client in question is going to be covered by Medicare. When we talk about their 27, Medicare payment. If they're going to be paying Medicare Part B in 27, the 25 return is going to be tested for IRMA. And while it won't be these numbers, rather it'll be next year, what they report a year from now, these numbers give you some really good idea about where the IRMA brackets lie. And you want to make sure that if you're planning and trying to dial in the IRMA bracket, that you understand what does and does not affect AGI. That is crucial. Okay, so be careful there. Next up, we have alimony returns. This is DiTullio versus Commissioner. Tax Court Miranda decision 2025-120 came down on November 18th. This is a pre-Tax Cuts and Jobs Act divorce settlement, right? One signed in, and really that stretched one extra year under the law when they did this. So this includes settlements that were and they stretched it 1 year because, remember, Tax Cuts and Jobs Act was passed late in December of 2017. And the argument went that it would be unfair to penalize people, who just now are discovering this is coming to the law, who are in the middle of a divorce, and they're not going to be able to get the thing done in 2 weeks when everybody's taken off for the holidays. So they pushed it 1 year back. So these are divorce decrees through 2018. Are covered by and may still have alimony. They can't, if the decree is significantly changed after 2018 and it indicates they're going under the new rules, then that can change it. But this was not that sort of an agreement. So let's talk about the problem here and the problem that John didn't want to pay, for the entire cost of getting a quadro. That may have turned out to be a bad decision for John. Okay. Now, the question here was, there was a $50,000 lump sum payment. Was that deductible alimony? We look back to the old Section 71 and 215 that existed prior to the Tax Cuts and Jobs Act to make this determination. So because it was a 2017 decree, so before TCJA, we are looking at the old rules under 71 and 215. And this is a case of the problem we always had back then. Any payment made related to the ending of the marriage could be alimony, right? We had a test. We had to look in Section 71, and there were 7 requirements at the time, one of which is crucial here. And there were, and then there were some exceptions. Even if you met the 7 requirements, certain payments would not be alimony if they were tied to, when a child left, certain things that happened with a child, because that would be felt to be disguised child support. So that would turn out to not be treated as alimony. Plus, there was the thing called alimony recapture. Now, alimony recapture shouldn't be in play anymore because we're past the 3-year period, or should be, for a 2018 decree. We should be past when the 3rd year there would have finally come into play. We just kind of, figure that that's true. So it could be a 19, 20, and 21 return at best. The 21 return would have been filed in 22 and 3 years after that, which would be when the statute would go away, would have been in 25, and we're past the due dates then. So for the most part, the alimony recapture is not going to be an issue unless you're working on an old return that the IRS maybe is examining now. However, or somebody who just never filed the return. But the problem became if the document told you this. Now, state law judges cannot say this is alimony for federal tax purposes. Federal tax law under Section 71, specifically 71B, controlled if that payment was considered alimony for federal tax purposes. And again, state law judge does not get to decide federal tax issues unless the federal, unless Congress said, you can help us set this. But they haven't here. They're not going to follow just, is it alimony under state law? It has to meet specific requirements. Now, in this case, John is claiming, because he's the party who's going to court in this case, he's claiming that these payments were alimony. Now, the problem was that it met all 6 of the 7 requirements. There was no question it met. But the 7th one is a problem, and this one was often the problem when the taxpayer was trying to claim a payment was alimony. Under Section 71B1D, the old Section 71B1D, in place just before the passage of the Tax Cuts and Jobs Act, one of the requirements is there must be no liability to make the payment at all for any period after the death of the spouse who is to receive the payment. Question becomes, was this $50,000 lump sum payment, which related to his retirement account, which they failed to get a quadro? It was a employer-sponsored retirement account that didn't get the quadro, so we're there, right? So the key issue is this is a federal objective test. It got rid of the federal courts having to make subjective inquiries into intent or how state law would have ruled. They still have to kind of look at one issue here, but otherwise it was there. Now, Mr. DiTullio, had the burden of proving entitlement to the deduction, which means he had to prove that this payment, there'd be no liability under the agreement for him to make a payment if she had died before the payment was made. Now, the agreement was silent on that issue. It never mentioned that situation. So now what the court has to do is look at the underlying state law. In this case, the state, I believe, was New Jersey. And they have to look under that law, would this type of payment, with this fact pattern, be judged to be under New Jersey state law, looking at court cases and the history of rulings in New Jersey. Would the Supreme Court, or the court with the highest level of jurisdiction in the state, which is the Supreme Court in New Jersey, is not called the Supreme Court in New York. We won't even get into New York's weird naming of their courts, but it's not called that in New York. So if you're in New York and you see something from a Supreme Court of New York, realize that's really a trial court. It's always funny with New York. Just accept it. Don't try to explain it. Accept it. But in this case, would they have to pay it if she had died? So that's really the key. Now, this $50,000 was a settlement for the ex-wife's share of the petitioner's lump sum retroactive disability pension benefit. Hold it right there. Had a quadro been taken out at that point, then it would have clearly been not includable in John's income but taxable to her as the alternate payee. That's in the law. That's not under alimony. That's just under the plan rules and the quadro rules under the 400 sections in the code. But turns out in this case, no quadro was gotten. The final judgment of divorce provided for the ex-wife to have a share in the pension benefits, and it required them to obtain a qualified domestic relations order. In this case, the state judge understood his role, right? He can say you have to divide this, and he does have the right to say that. John, you got to make sure that your ex gets the lump sum payment that eventually will come out, or any payments that come out of your retirement account, gets her share. And this was her ultimate settlement. She would take $50,000, and that would be in total payment. But there was no quadro ever actually put together. Generally, a quadro is drafted by an attorney separate and apart from the one that does divorce work, because it requires somebody who is a qualified retirement plan specialist who understands the requirements of a quadro, because basically the administrator of a qualified plan covered by ERISA is directed not to pay to anybody but the employee unless there is a valid quadro presented to them. And what's going to happen the minute you present them with something claiming to be a quadro, the plan administrator, especially in larger plans, is going to immediately send it over to legal. And they're going to tell them, yeah, it passes all the requirements, or no, it's deficient in some way. Well, in this case, there never was one given to the plan administrator. And the issue was, his ex-wife failed to pay her share of the fee to get the quadro prepared by this plan attorney. So it was never prepared, never presented to the plan administrator. That means the plan administrator only could pay the $50,000 out to John. And it's taxable to John. Okay. Now, the way under a pre-2019 divorce decree that you might be able to save the day is if you could show that that payment qualified as federal tax alimony, right? We don't care about, the state judge can't label it alimony. Well, they can, but it won't count for this purpose because of federal determination, not state. But it might qualify. And there is a pretty good chance it will for 6 of the standards, right? But the problem is now the question arises, if his ex had died before the payment was made, before he took the distribution from the plan, did he still have to make the payment? And that's the problem. The agreement was silent because the agreement, which I assume his attorney, agreed to and told him, John, this is a good thing, and told him we need a quadro, right? We're going to ask for a quadro. It was all done right. You cannot fault the family law attorney in this case. Now, some cases you can fault the family law attorney for screwing with the taxes, but in this case, John appears to have gotten the right counsel. And his ex, she was told it was there. She's supposed to pay it. Now, the problem becomes, I'm sure the agreement said she's supposed to pay 1/2 of it. I am sure that John could have taken her to state court in New Jersey, and he could have had the court order her to make the payment, right? Or hold her in contempt of court. She was supposed to pay for this. But she said, I'm not doing it. Now, her attorney, hopefully she talked to her attorney. Attorney probably told her that if you do that, you're facing contempt of court. I would advise you not to do that because that can be problematical. Jail time, big fines. But if there's no quadro, what would the tax effect be? Well, he's still got to pay you this, right? Because that was ordered. And he's going to be the one to get the tax, tax will be taxed to him. And then the fight's going to be over whether this payment represents alimony. Now, I doubt she ever got any of this, put into her. All she knew is she didn't want to pay another cent. She was mad at him, etc. You can imagine the whole story. We don't know it, but you can kind of imagine that relations are a bit chilly between the ex-spouses. That often happens, shall I say. So she didn't pay for it. Well, he wasn't going to pay for hers. And it turned out badly for him. In June of 2020, the parties secured a consent order, formalized $50,000 lost payment, and they specified no quadro was necessary. Finally, we got this settled, right? They had a perfect agreement. He wasn't going to pay for the quadro. She didn't want to pay the fee. Finally, they negotiated a settlement and filed for a consent order with the court. So fine, that's there. Now, I guess the real question will be, was John informed by his counsel, what the consequences of not getting a quadro would be? Let's assume he was. He was just now mad because she wasn't paying what he thought she should pay, what he thought she'd agreed to pay. And so he wasn't going to pay for it. And people get that way and get very stubborn. Okay? Since neither the basically final judgment of divorce nor the consent order contained any language specifying the payment obligation would terminate upon the ex-wife's death, we now have to go to the state law. Would New Jersey, if she died before, this thing got settled, would the state of New Jersey require him to have made this payment to her estate? And if the divorce instruments are silent, which they are, the requirement here for not payable after her death can be met if the termination occurs by operation of state law. So now we have to go try to figure out what would New Jersey require. And in this case, the tax court found New Jersey law was ambiguous regarding whether maintenance obligations terminate upon the paid spouse's death when the instrument is silent. There was no obvious guidance in New Jersey law. And remember, the burden's on John and John's counsel to prove that it would have terminated. If we don't know if it would have terminated, John's not getting the deduction, right? He's not getting the alimony deduction. And she, of course, is not necessarily having to pick it up. Okay? So in any event, what happened in this case was, therefore, now the petitioner argued that the reference to a quadro incorporated the regulation requiring cessation upon death under New Jersey law was rejected because no quadro was executed, right? Since state law was ambiguous, the court was required to analyze the plain text of the governing instrument to determine if the fixed liability was created. So its conclusion was, relying on the language of consent order, that he shall give Lisa Lopez $50,000. Therefore, that shall give and shall be entitled seems an unqualified fixed liability, similar language previously found by the court to be enforceable by an estate. In the ultimate finding, they concluded the obligation of $50,000 would have survived Ms. Lopez's death. Now, she didn't die, but that's not the question. Had she died before receiving the payment. And therefore, since the payment failed to meet the objective requirements to be alimony under Section 71B1D, it was not deductible as alimony. John picks up the income, gets no deduction. Absolutely make sure when dividing a plan, especially now because we don't have the alimony out anymore, make sure the quadros are executed. And if you do have a pre-2018 divorce, a pre-2019 divorce decree, and a payment under that to settle a plan's being negotiated, make sure you discuss the problem of this should be a quadro. And if it's not, then somebody better get a legal opinion about why, let's say here for me, the state of Arizona would not require payment of this settlement if she died before it's finally paid. Make sure you found that, right? And that's going to be key. Okay, let's talk about the 139L interest exclusion found in OB3. Talk about a couple of OB3 things here at the end. Okay. Now, this is Section 139L, newly added by the One Big Beautiful Bill Act on July 4th of this year when it was signed into law. A qualifying lender can exclude 25% of the interest received in a qualifying real estate loan. Now, this is related to real estate for agricultural loans. We'll find out. The remaining 75% is taxable, but it's going to reduce, so basically it's like a 1/4 drop in the tax rate effectively. Now, it applies to tax years ending after July 4th of 2025, so it would apply to a 25 calendar year return. And a qualifying lender, now this is limited, must be an FDIC-insured bank or savings association, a state or federally regulated insurance company, certain entities wholly owned by a bank or insurance holding company, and certainly certain federally chartered instrumentalities related to agricultural loans. So it is a restricted group, primarily financial institutions and insurance companies. A qualified loan must be secured by rural or agricultural real estate or a leasehold mortgage on such property. The qualified lender must hold a valid and enforceable security interest in the property at the time the interest accrues. That's requirement. And the rural or agricultural real estate must be substantially used for agricultural production, fishing or seafood processing, or as an aquaculture facility, right? Minimal or incidental agricultural activity, a small personal garden, generally does not qualify, right? Now, I know there's some states, I forget, there's at least one state where apparently having a very minor amount of a garden on a property makes it farming for property tax purposes. That's not going to help you here, right? Don't worry about that. Now, a loan's qualification is determined solely by its nature and use of collateral, not by the use of the proceeds. The proceeds do not have to be used to acquire the farmland. They don't have to be used for the farm. It just has to be basically a loan secured by the farming property. And a subsequent qualified lender may rely on the exclusion for any subsequent holder, the exclusion that was determined, same method. Now, the loan eligible for the exclusion is limited to the fair market value of the securing property determined as of the issue date. There is a special safe harbor added by this. And I should say, I don't think I gave the citation. Let me put that back on the screen for right now. This is notice 2025-71 from November 20th. Yeah, I forgot to put that on screen. Okay. So it's limited to the fair market value of the securing property. That loan is treated, though, as fully secured if the fair market value of the property is at least 80% of the issue price on the issue date. Okay? The valuation could use any commercially reasonable valuation method used in the ordinary course of their business that can incorporate expected income from qualifying activities, such as a projected harvest value. Lenders may add the fair market value of related personal property, livestock, or farm equipment to the real estate fair market values, provided the loan is substantially secured by the real estate. And subsequent retesting of fair market value is generally not required unless there is a significant modification of the loan, as provided by Regulation Section 1.1001-3. There has to be a significant modification under that regulation. If a loan is not considered as made after July 4th, to the extent it refinances the debt issued on or before that date. Only the new portion of the loan, right, the portion of the new loan that exceeds the pre-enactment outstanding balance would qualify. This is kind of backwards to the way we think about mortgage refinancing, right? In this case, we have an old loan. The old loan, if we refinance the balance of the old loan, that amount of the principal, so that amount of the loan proceeds is not going to be considered qualified, basically a qualified real estate loan for this purpose for the lender, rather just the excess. A loan loses qualified status if the lender learns it is no longer secured by that property. That status can be protected if security interest is restored within 90 days of the lender obtaining knowledge that the security interest has been lost for whatever reason. The taxpayer can rely on this interim guidance, because this is meant until they get regs out, found here in Notice 2025-71. And the IRS intends for forthcoming proposed regulations, though, to be similar to this guidance. So in theory, when the final rules come out, the plan right now is those final rules are going to provide the same thing as this notice does. Finally, this week, we got late in the week on the 21st November in Notice 2025-69, how the employees are supposed to handle the OBBBA deductions for qualified tips and qualified overtime compensation. Now, this comes from, new IRC sections 224 for qualified tips and 225 qualified overtime that were enacted under the One Big Beautiful Bill Act, is what we're talking about here from the employee's position, the person receiving the payments. It applies to tax years beginning after December 31st, 2024 and before July 1st, 2029. So 24 through 28 tax years. Both deductions are subject to a phase-out if modified adjusted gross income exceeds $150,000, $300,000 per joint filers. Now, under OB3, it required separate reporting of these potentially deductible amounts on Forms W-2 and 1099 for this year by the payors. However, the IRS confirmed the 25 forms are not going to be modified to include this accounting, and also provided a couple of weeks ago that the employers don't really have to provide this information. Essentially, they're encouraged to, but don't have to. So now we get into a bit of a mess. Okay. 2025-69 is now the second half of this. We already told the employers, you guys don't worry about giving the employees this year. We'd hope you would, but you don't have to. How does the employee deal with that? Because again, the law requires specifically that these amounts be reported to you on a W-2 or a 1099, or reported by you on the 4157 for the unreported tips to your employer form. So those are the way in, and we know it's not going to come, on there. Now, your employer may give you a statement if you're lucky, that tells you what your qualified tips are, it may tell you the qualified overtime, but what do you do if they don't? Okay, let's talk about qualified tips. Maximum deduction, as you should be aware, is $25,000 annually. Tips must be cash tips, including cash or charge tips and tip sharing amounts. Tips must be received in an occupation that customarily and regularly receives tips pre-2025. This is going to be a number for that occupation, and it is going to be reported on the W-2s and, at least in theory, 1099s, but not for 25 W-2s and 1099s. Rather, it's going to show up next year. But you still got to make sure you're in that list, which currently exists in the proposed regulations. And there really were not many comments on those regs when they had the quote hearing day, electronic hearing day. So I suspect that list will be the final list. But you do need to be in one of those occupations. The other requirement for tips is you can't get it if you earn those tips if, in a trade or business. Your employer was in a specified service trade or business, or if you're self-employed, you are in a specified service trade or business. For 2025 and until January 1st of the year following, the year in which the final regulations are issued, all tips will be treated as not received in SSTB as long as the occupation itself is allowable for tips. That means that, at least for 2025, let's say you're a self-employed entertainer and you're getting 1099s from restaurants and everything, and they separately, and they do, and we're going to be able to handle the tips. Now, you are, because you're the business, you're essentially in the business of performing arts, which is a specified service trade or business. However, the IRS says we realize that a lot of businesses, have not determined if they are or aren't. And so because of that, we're waiving the SSTB for this year. So that guy who is self-employed and is paying and playing piano in the restaurants, he will be able to claim the qualified tips this year. Although, when we get to next year, because he's self-employed and therefore the business is an SSTB, he wouldn't be able to claim them, assuming that we get the final regs out during 25. We get the final regs out by the end of this year so that 26 would be covered. More likely, he'll get them for 26 again, I suspect, given we're late in the year and the IRS has been on a bit of a leave for a while here. We'll probably get them in 27, so I'm going to suspect, or 26, so I'm going to suspect 27 will be the year. But that is important that we do have the SSTB relief. That is something that I had not heard suggested until this came out. Okay, that's it. Qualified tips we'll get here, and then we'll get to the safe harbors. Again, the deduction requirement is satisfied if cash tips are properly reported in the Form W-2, even without separate accounting for this year under this rule. Okay. Now, how does the employee, though, calculate it? Because, again, not all tips are going to work for this. Well, you can elect to use any of the following amounts. Total Social Security tips reported in Box 7 of the Form W-2, you can elect to use those. Any other tips reported to the employee, by the employee on Form 4070, which is reporting I didn't get the tips, or tips voluntarily reported on Box 14 of Form W-2 or a separate statement by the employer. Employees may also include any amounts listed on line for the 2025 Form 4137, the unreported tips amount, tip income. Okay. Adequate records, tip logs, payroll statements must be maintained, right, in this case. For overtime, 12.5 for individuals, 25,000 per joint. Now, these only apply to amounts paid in excess of the regular rate. This is the premium required under the Section 7 of the FLSA. This is normally the half portion of the time and a half pay. So if your normal rate was 100, you worked one extra hour in the week, so 41 hours. You got paid 150 for that hour. The overtime deduction is 50, not 150. I know your total you were paid for overtime. You're going to look at the way most people count, that'd be 150. That's true. But only the bonus you're paid, the $50, will count. Payments exceeding that FLSA required premium, like the employer voluntarily pays double time, those excesses are not qualified overtime compensation. You can only deduct the 50%. So the rest, the other 50% that makes up the double time, non-deductible. So let's say you're paid $200 instead of the $100 because the employer is paying double time for your overtime, paid voluntarily by the employer or maybe paid due to collective bargaining agreement. You're only going to get $50 of overtime deduction, right? It must be FLSA. Only overtime compensation paid to an individual who is covered by and not exempt from FLSA can qualify. So the IRS can attack this by saying you are an exempt employee under the Fair Labor Standards Act. So you're going to have to understand what is an exempt employee, right? That's going to be something that's going to be important to understand when you're counseling people on this. If you are married, you're going to have to file a joint return to claim the distribution, right? Reasonable methods you can use for overtime. In essence, because you have specific reporting, there are a number of reasonable methods. First, you can do a separate, if the employer separately accounts for the overtime premium, the half portion, bingo, you've got it, right? They could just give you the real number. You can use that. If the statement shows the aggregate dollar amount for time and a half, the qualified amount be 1/3. So let's say let's say the statements they give you show your overtime. It is all just FLSA overtime that is federally required. You know what they're reporting is time and a half. 1/3 of that is deductible. You can use that. That's method 2. So $15,000 in aggregate overtime would give you a $5,000. Take 1/3 of that, you're good. If there's a higher overtime pay rate, if paid double time, the qualified amount is determined by multiplying the aggregate rate by an appropriate smaller fraction. $20,000 in aggregate, double time yields a $5,000 deduction. Now, one of the problems you're going to have, you got to use a reasonable method based on pay stubs or invoices. Where it's going to become more complicated is, for instance, if your client is an employee in California. California has much stricter overtime rules that require paying it, for instance, any day an employee works more than 8 hours. So maybe, somebody worked 9 hours on Monday, or maybe let's say, they only work 7 hours on Monday. And so they worked 9 hours on Tuesday to make up for that missing hour the day before. So they still have 40 hours for the week. So they have 40 hours for the week. In California, they'd be paid overtime for that 9 hours on Tuesday for that hour. None of that would be qualified overtime for federal purposes. California also has certain situations that trigger a 200% payment. So in California, without the employer's cooperation, it may be very difficult to determine the proper overtime unless you got a client that keeps really, really good records. So be aware of that. Now, in general, on the tips, if the person is a 1099 employee, the safe harbor provides that, or 1099 employee, but 1099 individual, like that, the person playing, goes around, plays multiple restaurants as entertainment. They get tips. Let's say the restaurant therefore pays them each week, the tips, because maybe they allow tips to be added to the credit card charges, tips to divide between the servers and the musician, whatever, or they just collect the tax tips and then, he's part of the pool for it, whatever it may be. As long as those tips are reported on as long as those tips are included in the amounts reported on 1099, you got to document that you receive, and you have documentation, then you're fine. But they are enforcing, it's got to be reported on one of those forms, or you got to basically, do that unreported tips to your employer form, which could really complicate matters because you're claiming those people are your employer. And yeah, we get into all kinds of mess there. So we don't want to bring that up too much. But yeah, we still do need the 1099s. That will complicate matters for somebody, let's say, who is a self-employed hairstylist. The 1099K, maybe they can do it due to the, they take credit cards and the like. And they can, hopefully next year they'll provide a way to separately tag the tips. You'll tag the tips and they'll report them that way as what you had as your tips. But you have to realize that reporting's there. If they're getting paid in cash, that's going to be a problem. Potentially, it would appear. We'll find out for sure in the final regs, but keep an eye on that. Well, this has been the Current Federal Tax Developments for the week of November the 24th, 2025. As always, you've got my email address there, edzollers@currentfederaltaxdevelopments.com. And I also do watch the posts on the Connect sites for the Arizona Society of CPAs, New Jersey Society of CPAs, Idaho Society of CPAs, Minnesota and Illinois societies. So keep your eye out there. If you have any questions and you post one there, I'll try to respond. Otherwise, we hope to see you next week. I expect next week may be light, although that might be tempered slightly because, the IRS is coming back and into work, so they may be pushing out some stuff that didn't get final review while people were missing. So we may see some extra guidance going on. that'll be approved and come out. We certainly saw a bunch more private letter ruling stuff this week, which I expect to continue as they catch that up, because those were not continued by the staff that was there for the most part. We'll just see what happens. But in any event, next week is a short week, so we'll be there. I plan to try and record during the Thanksgiving weekend. I am traveling on Sunday for doing an out-of-city session for a firm. So I'll be outside of the state for that day, for Monday. So I hope to get it up during the weekend, and not have it show up, unfortunately, on, not have it delayed, because obviously when I'm traveling, and it's going to be a little fun to record in a hotel room, because you got to get the room first thing, and that usually won't be until they give you the time that you're allowed in, around, potentially 3 o'clock or 4 o'clock in the afternoon. So as you might say, we may not get things done. And then there's always trying to upload something from a hotel. It can be kind of messy. So hopefully we'll get that together. But otherwise, we will see you next week for more current federal tax developments.